Hello and welcome back to Money School, where you can always find out stuff you want to know about money, just didn't know who or where to ask. So here we are. Now you've listened to several of these hopefully, and here's the ones that we've already aired. Basics on budgeting, all about debt, savings, and last week we talked about bank accounts. And today is the one, I hope you got a pencil and paper because we're talking about investments, investing for retirement. But before we go there, let's just see how much you've learned so far. Got a real quick quiz for you here. Let's see how many have the answers. Budgeting, here you go. This is the foundation, all right? So what is the single most important part of your financial plan? I already gave it away. It's budgeting. If you haven't watched that lesson, go back and do it. Don't watch this one. You got to go back and do the budgeting one. It is the most important one. In budgeting, you're going to find out you give every dollar what before the month begins. I heard some of you say, a name. That's right. You want to name every dollar. Give every dollar a name before the month begins. That's a sign of a good budget. All right. Next session, we talked about debt. How do you get out of debt? Well, first of all, don't go into debt. That'd be good. But if you're in debt, how do you get out? We use something called the debt snowball. Go back and watch that lesson. You'll fully understand that. And then we must learn to blank debt. What? This is something your parents probably told you not to do, but we're going to tell you to go ahead and do it. We want you to hate debt, not dislike it, but hate it. Okay, so you got budgeting, you got debt. Now savings, all right? What do you save for? You need to have a 3 to 6 month emergency fund. That's in savings. That's not an investment. We're talking about that today. And then any money in a savings account is supposed to be there for something that you're going to spend within 5 years. So if you're saving for a car, a vacation, or something like that, that is not an investment. That is a savings account. All right, then last week we talked about opening bank accounts. Did you realize there's 7% of Americans that don't even have a bank account? Well, why do you need one? Well, you need it for direct deposits, at least for your paycheck. How about a stimulus check? If you didn't have a direct deposit, you got maybe mailed a check. So you need that direct deposit. You need to have that bank account so you can have a direct deposit. And tax refunds. Man, you file those taxes and you get a refund, boom, hit your account. All right, that's a quick review on the 4 sessions we've done so far. All right, buckle up. Got that pencil and paper? We're going to be talking about investing today. Before we do that, I got to do this disclosure, it's required. If you want to read all that, you can. I'm going to go through it pretty quick. Basically says what we're going to talk about here today, do not act on. I'm not talking about your specific situation. This is broad brush, okay? And then the next one is if we talk anything about Social Security, and we will, it's not about your Social Security. It's top line Social Security. All right, got the legal stuff out of the way. Now, when we get married, have a girlfriend or whatever, this is kind of the picture we have. Oh man, everything's great. It's happy. And then after a few years of marriage, it kind of looks like this. Like, oh, got a couple kids. Look at the faces there. It's like, man, what's going on? And then in retirement, this is what we hope it's going to look like. Walking on the beach, walking hand in hand, everybody's happy. Well, that doesn't happen by accident. You got to plan for it. And how do you do that? Well, you do it by investing. And we talked about a couple weeks ago about savings. Savings is when you're going to use money within the next 5 years. Investing then is funds you're going to be used 5 years or longer. And we explain why the 5-year mark in that one. Bottom line is, if you put money in for a short term into an investment, the likelihood of it going down is pretty high. But if you leave it in there for the long term, the likelihood of it going up is also pretty high. So investing is long term. Got it? Long term. I hit you with one little quiz there. I'm going to hit you with another one here. All right. See, write down your answers. These are multiple choice. Should be fairly easy. Okay? Suppose you had $100 in a savings account, earning an interest rate of 2%. That would be fantastic today, by the way. But let's say you're getting 2%. After 5 years, you don't put another penny with it. After 5 years, how much do you think you'd have in that account? Multiple choice, write down your answers. A, more than $102. B, exactly $102, or C, less than $102. Write down your answers. Number 2, imagine that interest rate on your savings account was just 1%. That's closer than what it is today. 1% a year. But inflation is 2% a year. After 1 year, how much would you be able to buy with the money in the account? Again, you're earning 1%, inflation is 2%. How much can you buy with the money in the account? Multiple choice. More than you can today, exactly the same as today, or less than today. A, B, or C. All right, last question. Tell me whether you think this statement is true or false. Buying a single company's stock usually provides a safer return than a stock mutual fund. A single company stock versus a mutual fund. Single company stock is safer than the mutual fund. True or false? Tell me your answer. Okay, you ready for the answers? Here we go. Number one. Well, first of all, millennials did this test. The millennials said they are financially literate. They said, yes, I know about finance, I can do this. Only 19% of them were able to answer all three of these correctly. So if you don't get them all right, don't feel bad. All right, here we go. First question. Suppose you had $100 in a savings account, interest rate at 2%. After 5 years, how much would you have? Well, you'd have more than $102. The first year, you have $100, you add 2%, that makes $102. The next year, you'd add 2% to 102, so that would make it 104, maybe 105, and so forth. So the answer is more than 102. That's compound interest over the 5 years. Number two, if the interest rate was 1%, inflation was 2%, would you be able to buy more than today, exactly the same, or less than today? If you said C, less than today, you were absolutely right. Boom, got 2 for 2. Question 3 says, true or false, buying a single company stock is safer than a mutual fund. What did you say? If you said false, you would have been right. There you go. 3 questions. Did you get them all right? If you didn't, don't feel bad. It was like, man, I need to know this stuff. Well, that's why you're watching this. So here we go. We're going to jump right into it. Many of the U.S. workers expect to retire at 65 or later. Can you believe it? 65 or later. 40% of them think, hey, I'm going to be working past the age of 65. I'm going to give you an example. Here's your tease. I'm going to give you an example today on how a couple that are losers, by the way, and I'll explain that, retire as millionaires. Stay tuned. You're going to see it here in just a few minutes. Okay. Retirement age in multiple countries. In the U.S., 66 is about the average retirement age. 66. Can you beat that? You can if you pay attention to this video. This is really interesting. How much are people saving for retirement? How much? Well, look at this. Only 16%. 16% of the population is saving the 15% or more that we're going to recommend. There's more people not saving anything than there are people saving what they should be saving. Where you fall in this? Do you save 5% or less, 6 to 10%, 11 to 15, or more than 15? Answer that question. If you're in the 15% or more, you're on the right track. Here we go. This is kind of an average here on what you need to save by age group. And this is assuming you make about $61,000, $62,000. So if you make that kind of money at these different ages, that tells you what you should be have saved by then. Okay? Kind of a rule of thumb, doesn't have to be exact, just kind of a rule of thumb, kind of gauge where you are. Here we go. First things first. If you came in here and you had a $10,000 bonus and you said, Mike, I want to invest, we would say, wait a minute, going too fast. First things first. Do you have your budget? You've already heard that once in this video, right? You got to do a budget. It's the bedrock. It's the foundation of a financial plan. If you don't do it, we're not going any further. Do a budget. Next, do you have 3 to 6 months of emergency fund set aside? 3 to 6 months of expenses. Okay? How much are you spending? How do you go know how much your expenses are? Unless you do a budget. You got to do the budget. Do the budget. Then when you got 3 to 6 months of expenses, then we can start talking about investing. Okay? We do want you to get out of debt, completely out of debt. You know, it'd be crazy if you come in here and put $10,000 in and you got $30,000 of car debt. I mean, get that car paid off and then let's talk about investing. Okay? Budget, get the 3 to 6 months of emergency fund, be out of debt, and now we're ready to start investing. How much, Mike? About 15% of your pay. 15%, not 10, not 20, 15. And you do that before you do any college planning. Well, wait a minute, my kids go to college. Well, we're going to get to that piece, but here's a quick example. You're 65 years old, you're ready to retire, and you walk down to the bank and say, hey, I want to borrow money for retirement. What are they going to do? They're going to laugh you out of there. But if Junior decides he wants to go to college and you haven't saved for him, could he get loans or grants? Yes. You can't for retirement. They can for a college education. Now, we don't recommend getting student loans, but worst comes to worst, they can get them. You will not be able to. Okay? The power of compound interest. We should not be able to graduate high school without knowing this concept. So you're going to get lots of examples here, so I hope you got a pencil and paper and write these things down. There's a Ben and Arthur story. And when we're done with this, if you Google it, you'll be able to see it and you'll see the charts. It is fantastic. It'll blow your mind and it's absolutely accurate. Okay? Bottom line is you got to start investing, saving and investing as soon as possible. All right, here's the Ben and Arthur story. So on the left, here's Ben. These are brothers, by the way. Ben's pretty industrious. At age, 19, he starts saving $2,000 a year. There is nothing magical about 2,000. This is just an example. Ben saves until he's 26. So he goes from 19 to 26. He saves $16,000. $16,000, that's it. He doesn't save another penny. Arthur over there says, hey, Ben's over here. He's saving some money. I need to kind of get on the train and see if I can start saving some money. So Arthur does. Arthur, at age 27, starts saving $2,000 a year, and he saves it all the way to 65. Arthur saves $76,000. Ben only saved $16,000. Now, intuition may tell you, well, heck, Arthur's going to have a lot more money. Well, he doesn't. If you'll notice, Ben ends up with more money at age 65 than Arthur does. The exact same rate of return, exactly the same. He ends up with what, about $756,000 more, $750,000. And the only thing he did different was he started sooner. He got the compound interest snowball rolling faster than his brother Arthur, and Arthur never caught up. If you're sitting there scratching your head like, well, Mike, I'm not 19. Well, you got to start where you are. You got to start where you are and get this thing, compound interest, working for you. All right, so here's another example. Here's an example of an 18-year-old that saves $200 a month, $200 a month, and gets an average rate of return of 8%. You'll notice there, he works for 45 years and he has $1 million after 45 years. But notice the compound interest. If he keeps going for another 5 years, it adds $500,000. So that interest is gaining interest on top of interest. That's the power of compound interest. It takes 45 years to get to $1 million and just 5 more years to add another $500,000. Wow. Can you do that? $200 a month from 18 till he's 65 or 70, or 68 in this situation, and you can have $1.5 million just making 8%. 8%. It's doable. All right, here's the numbers, and notice the green line at the bottom. That's what he's saving. The interest is the orange line. Look how it just explodes because it's interest on top of interest on top of interest. Power of compound interest. It's fantastic. Make it work for you. Okay, let's get into investing. What is investing now? So you got some examples. You know you need to. You know it's possible if you save it, the power of compound interest is going to work for you. All right, Mike, so how do we do this thing? All right. Investing means you're going to put the money in and leave it in for at least 5 years. At least 5 years. Remember? Because you put in shorter time, it could go down. Long time, it'll grow. All right. So, what can you invest in? Well, if you have a job, most companies offer a 401k. What is a 401k? That is the tax code, 401 Section K, that explains this particular vehicle. Basically is you put money in, the company matches it, and over time, you're going to have a large sum of money, okay? Now, inside the 401k, you have investment options. You need to spread those out. We're going to talk about diversity here in a little bit. A 403b is the cousin to a 401k. 401k is mainly for private companies. 403b is mainly for hospitals and teachers and things like that, nonprofits. Basically the same thing, just call it different letters, okay? SEP, Simplified Employee Pension. If you're self-employed, would you want to use one of these? There's some great tax advantages for these. How about an IRA, Individual Retirement Arrangement? Most people have heard these. That's where you yourself can open up an account. You can do it here with Mach 1. We can do an IRA and you get a tax deduction for those. All of these offer a tax deduction on the money you put in to the fund, okay? Roth IRA, on the other hand, you pay the tax now and you never, ever, ever, ever pay tax again. It is one of the great wonders of the world as well. Compound interest and Roth, fantastic. And we can dig into those a little deeper. If you are lucky enough to have a pension, used to be commonplace in companies 20, 30 years ago. Almost no private companies offer a pension today. If you work for a city, a county, a state or a federal organization, you probably have a pension. Pension is you work there for 20 years, that institution is going to put money back for you, and when you retire, they're going to give you a stream of income, usually for life. And if you're married, then your spouse also gets it for life. Now, downside of a pension, especially if it's with a private company, a pension is an asset of the company. The company goes bankrupt, pension goes with it. 401k, 403b, you own it. Doesn't matter what happens to the company. It's yours, okay? HSA, well, wait a minute, Mike, we're talking about investments. HSA is a health savings account. It goes with a high deductible health plan. Why is that in with investing? HSA has triple tax benefit. Nothing else does. Triple tax benefit. The money you put in, you get a tax deduction. The growth on it is tax-free. And when you pull it out and use it to spend on healthcare related expenses, it's tax-free. It's like an IRA or a 401k going in and a Roth coming out. You don't pay any taxes anytime as long as you use it for healthcare. And the reason we have it in the retirement piece, investment piece, we highly encourage people to contribute to it over the years. If you can afford it, do not pull out of it until you retire. Let that thing get all the tax-free growth until you retire, and then pull that out for your medical expenses, and it's like another retirement fund. If you're scratching your head like, well, how do you do that? Give us a call here. We'll sit down and we'll go over all the details on how you can use an HSA in retirement. It is wonderful. Okay, so which one's best for you? Well, it depends. That's usually the answer for everything in investing. What's your situation like? We don't know. Are you married? You're not married? You're widowed? Divorced? You got one child, no child, 10 children? All those things come into play when we make decisions like this. So, best thing for you to do is find a qualified, licensed financial advisor that is a fiduciary, meaning they are required to do what's in your best interest. Don't assume every advisor is a fiduciary. They are not. Simple question. Are you or are you not a fiduciary? If the answer is no, keep going. Come to Mach 1. We are fiduciaries. We'll be glad to help you. Okay. Investing 101. Here we go. Let's get into it. Things you got to think about before you start investing. Remember, investing is long periods of time. Okay. What are your expenses? Well, you can't know that unless you do your budget. Go back and watch that one if you haven't, and be sure you're doing that budget every month before the month begins. What are your goals? Do you want to retire at 60, 65? Do you want to buy an RV, second home, travel the world? What are your goals? So you got to know your budget. You got to know what your goals are. Where are you going? Okay. Where are you now? So we need to find out, where are you now? Where do you want to go? And a good financial advisor will create that path for you to achieve those goals. Okay. What's your risk tolerance? Hey, Mike, I don't want low risk. I want zero risk. Or, hey, I want to roll the dice. I want to get aggressive and I want to make as much as I can. Everybody's different, and neither of those is correct unless it's for you. So there's no wrong answer there. It's what fits you best. How quickly will you need the funds? We've said investing is 5 years or longer. You said, Mike, I'm going to retire next year. Well, we don't invest then because you're going to be needing it next year. Unless you say, Mike, I'm going to retire next year and I don't need to touch this money for 5 years. Then we would invest. Okay? What are your sources of income that you expect in the future? Where are you going? You may get an inheritance. You may or may not. You may get tax returns every year. You may be getting bonuses. You may have stock grants, stock options, those things coming in. How about a pension? Do you have that? How about Social Security? Mike, I hear Social Security is not going to be around in 2034. We'll cover that in one of the lessons. It will be here. It may look a little different. It will be here. So, what are your other sources of income? We take all that into consideration before we start investing. What's your family dynamics? Hey, Mike, I got a bunch of crazy people in my family. I need to make sure this money's safe. Or, hey, we got a close-knit family. Everybody's good. What's going on in your family? We need to know that. Do you have a special needs child that you need to be putting things aside for them, for the future? Or do you have elderly parents who are going to come live with you? We need to know all of that to make a good plan. Okay? Are you planning on funding your kids' college? Either a piece of it or all of it. We'll need to know that, and we can plan for that as well. And then we want to do all of this as tax efficient as possible. We think there's going to be a tax time bomb go off here in the probably not too distant future. So you're going to hear us talk about Roth IRAs and why they're so important. Pay the tax now when the taxes are on sale, so later on you don't have to worry about that. Okay. Investing, we've already talked about. You got to have 36 months of expenses set aside. You never know when you're going to get laid off, you're going to get hurt. You got to have some cash sitting on the side so you're prepared when life happens. Okay? So that keeps you from borrowing money when things do happen. 40% of Americans cannot fund a $400 emergency. They can't do it. They just don't have the cash. 3 to 6 months of emergency fund will provide you that cushion. Where do you put it? High yield savings account, a money market, just a regular passbook savings account. All you're doing is setting money aside. It's not going to make you money. It's not an investment. It's there to protect you when something happens. Get out of debt, set for your mortgage, get it all out. Now think about it. If you look at your budget, I know you're going to do your budget. We've talked about it. When you do your budget and you have no debt except your mortgage, man, that budget gets a little smaller. And when you have a 6-month emergency fund, it doesn't have to be near as big. So get all those debt out of your life, okay? The interest on debt that you pay, that is, you're paying a penalty. You're paying a penalty when you're paying interest, okay? Here's some investment guidelines, big, broad brush guidelines on investments, okay? 15% of your salary going towards retirement in some kind of a tax-favored account. IRA, 403B, Roth, something like that. 15%, okay? The first place we would go is any place you can get a match. That's most often a 401k or a 403B, something like that. If your employer's offering a match, you need to do at least that into a 401k or 403B. Get that match. That's 100% return. Free money. Get it, okay? Then, most likely would recommend you doing your Roth contribution. Pay the tax now so you never pay it later. We're going to give you an example here in just a second. And then if you still have room in that 15%, you either go back to the 403B, 401k, or just open up a traditional IRA, individual retirement account. Okay, so here's the example I teased you about earlier. This is a couple and they're losers, and I'll explain that. And so they make below average. The average for the United States is about $60,000 a year for a couple. This couple only makes $50,000 a year, okay? 15% of $50,000 is $7,500 a year. That's what they need to put away each year to have a good retirement. All right, so how we break that out? Like I said, their 401k matches the first 5%. So they're going to put that 5% in and get that match. That's 100% return. You can't beat that. Then they've got $5,000 left over, so they're going to put that in the Roth IRA. Now, Roth IRAs have a limit per year how much you can put in. It's $6,000 a person that are under the age of 50. Once you hit 50 years old and older, you can do $7,000 as of recording here in 2021. So they're under that, so they're putting $5,000 into the Roth IRA. They paid the tax on it, they're putting it in there, they're good. So those two together, $7,500. So they get paid 26 times a year, so 2 months out of the year, they have magic months. They have 3 pay periods, okay? You need to plan for that. Okay, so if you do the math, that's $288 a pay period that they're going to be putting away for retirement. All right, get ready to do some math here. You ready? Pay attention to this. These folks are losers, but watch what happens. Okay, starting at age 30, they had some student loan debt, car debt, or whatever. They got all out of debt, and boom, at age 30, they started investing, and they do that all the way to 65. 35 years of investing. And they're very fortunate they get 9% return. The stock market's averaged about 10% for about 80 years. So 9% is doable. Okay? 35 years, putting $288 a pay period and making 9% on it. So what kind of results are they going to have? Let's see, Mike. Come on. Show me. All right, here we go. In the Roth, the tax-free piece now, they got almost $1 million. $1 million. The 401k, again, so we put $5,000 in a Roth and $2,500 in the 401k. They both made 9%. So it's going to be about half. So you got almost $1 million in the Roth and about $500,000 in the 401k. So now they got almost $1.5 million. That's pretty good. Could you retire on $1.5 million? Hey, hold on. We're missing something. What are we missing? You forgot about the match. The match is another almost $500,000. So here they end up with almost $2 million. Could you retire on $2 million? I could. You bet. Okay. Well, it depends on how much you spend. So now I got $2 million, and I've told you these people are losers. Look at this. If they do the rule of thumb, they take 4% off withdrawal, and that's just a rule of thumb. They're making $78,000 a year off their retirement assets. Now pay close attention to this. How much were they making a year? $50,000. They retire and they get almost a 50% bump in pay to retire. From $50,000 to $78,000. That's fantastic. But these folks are losers. Why are they losers? They never get a raise in 35 years. You think you'd hang around a place you didn't get a raise in 35 years? So this example is absolutely doable. But you know what? The hard part is you got to save that $288 a pay period. You can do this. Some of you are sitting there scratching your head like, that's not right. He can't. Rewind this thing, play the numbers, do the math yourself. These folks made it, and you can too. It's this simple. It's simple to talk about. It's hard to implement. 20% head knowledge, 80% behavior. What's your behavior going to do to make sure you save that $288 every pay period? You can do it. They did it, and they're losers. All right. So some people we get in here and talk about, I want to time the market, Mike. I know when to get in and when to get out. These people didn't time the market. They just constantly put it in. Dollar cost averaging. So here's a chart from last year before the pandemic. You see how it's moving, going up, going up, going up, doing great, right? And then this is, as of our recording today, this is what the stock market is today. Another 52-week high. What does that mean? This is the highest it's been in a year. Okay? Now, here's one here. This is back in February of 19th of last year, where the market took a dive and you see it start coming back. Okay? So this chart shows the bull market. What happened in February of last year? COVID hit, market just tanked, dropped 30% in 22 days, the fastest drop since the Great Depression. But what happened after that? You see it go right back up. Did you predict the COVID? We didn't. Nobody did. So the point of it is, you don't know, I don't know, nobody knows. If somebody tells you this is what the market's going to do, you should probably do the opposite, because nobody knows. Here's what this shows. In 2020, the first column there, the return, was about 18% overall. Okay? Not bad. That's actually pretty good. The average is between like 6 and 10. So 18 is really good. But if you excluded says, I take out the 10 worst days, Mike, you would have made 125% if you knew which 10 days to take out. But if you excluded the 10 best days, you missed the 10 best days, instead of having an 18% return, you would have had a negative 33. We're only talking 10 days either way, 20 days total. Who can predict that? Nobody can. So stay in it for the long haul. That's time in the market is more important than timing the market. One more time. Time in the market is more important than timing the market. The couple we showed you there, 35 years, and we had an average on there. We didn't have huge spikes, just a straight average. It is doable. Okay, diversify. You don't want to have all your eggs in one basket. You've heard that story. Well, I've got another unique example here for you. You won't forget this. In the Bible, it even says we should do this, right? That's the most important book we got. Give a portion to 7 or even to 8, for you don't know what disaster may happen to on the earth. Let me read that again. Diversify. Even in the Bible, it tells us to diversify. Ecclesiastes 11:2 says, give a portion to 7 or even to 8, for you don't know what disaster may happen on the earth. Nobody knows what stock's going to go up or down. You can guess, but you don't know. How many of y'all been by a farm? I grew up on a dairy farm. Dairy farm, we milk cows and a lot of cows. When you have a lot of cows, they produce a lot of stuff, right? Manure. So what do you do with manure? Have you ever driven by a farm and there's this huge pile of manure? Have you? You see anything growing on it? You probably see a lot of flies and things like that on it. So when you pile everything up in one spot, you put all your eggs in one basket, you have all your investments in one spot, nothing grows. But what if you take that manure and you spread it out over the fields? What happens? Things grow. There's your example of diversity. Spread it out and watch it grow. You leave it all in one spot, something bad's going to happen. Okay, you won't forget that. Okay, Mike, so what do you recommend? Well, in your 401k, IRA, things like that, if you have the options, this is what we would recommend. About 25% in some large cap stocks. What does large cap mean? Cap means capitalization. It means large companies, huge companies. Think Walmart, think Procter & Gamble, big companies. So large companies, 25% in those. 25% in mid-cap companies, medium to small size companies. And then 25% in small companies. Now the small companies are going to be a lot more volatile than the large companies, right? And then what am I going to do with the other 25%, Mike? Well, international. Now you don't have to stay hard and fast at 25. You might do 30 and 20 and some. And international, we've kind of reduced the size of that recommendation recently, maybe down to 20%. And then put it back, the rest of it, depending on your risk profile. You might want to put more in the aggressive piece and the small. If you're not as aggressive, put it in the large. Okay? But that's kind of a rule of thumb. Spread it out. Spread it over those asset classes and give you some diversity. You're going to spread it around so things will grow. Okay? If you're doing it with your 401k, look in your employer plans. Look for long-term track records. They should be giving you a prospectus or a sheet that says, here's the 1-year return, 3-year return, 5-year return, 10-year return. Well, anybody can do a really good in a year, so we don't pay attention to that. I want to go all the way out to that 10 or 15-year return, and if it's been consistent double digits, that's the one we want to get into. But pay attention to the expense ratios too. Yes, all those mutual funds charge a fee, so you got to know those as well. All right. If you invest in your own company stock, please limit it to no more than 10% of your total portfolio. If you've got $100,000 in your 401k, you should not have more than $10,000 in your own company stock. Think about it. Your paycheck's tied to that, and now you want to tie your retirement to it too? You may have a great company, but you could also have an Enron. People thought it was great, and when it went under, it took their 401ks and everything, and they had nothing. So spread it around. All right. Here we go. Summarize. This has been a little bit longer than most. This is the thing we're passionate about because it's what we do every day. First thing you got to do, first things first, you got to have a budget. If you don't have a budget, none of the rest of this stuff works. Okay? Get out of debt, stay out of debt. You got to hate debt. I mean, you can't be cozy with debt. You got to get it out of your life. Then you save and invest. Sooner you get started, the easier it is to be like that couple there that were losers that can retire and have a 50% pay increase in retirement. That'd be awesome, okay? First thing you do is go to your employer-sponsored plans where that free money is, where those matches. You got to get that. That's free money. Get it, okay? And then 15%, that's all, 15% into tax-favored accounts. Do not count their match. As we learned in COVID last year, a lot of companies suspended their matches. So we don't want to depend on that. You do 15% of your salary. If they match it, that's gravy, okay? Diversify, spread it around. Don't put it all in your own company stock. Don't do that. That's a recipe for disaster. And Warren Buffett likes to say this: someone is sitting in the shade today because someone else planted a tree a long time ago. You're planting trees for your family, for your retirement, maybe for your grandchildren by investing today. And you saw how that works out in this. If that's unclear, back this thing up. Go through that example again. That's an amazing example. Think about that Ben and Arthur story. That's true. And then when you've done that and you get to be these folks' age and you've got grandchildren like that, you're not worried about money. You're worried about legacy. And that's not a worry. Hope you enjoyed this. If you have any questions, we would love to answer your questions. Hey, comment on the video. Do the Facebook Messenger. It's on YouTube. You can comment on the video. You can come to our Mach 1 website. You can leave us, contact us there, the contact us button. Or you can call us, 479-876-2100. We'll be happy to set an appointment and talk with you, answer any questions you might have. No fee. Consultations are always complimentary here. We look forward to you on the next video. We got some more exciting news for you. Take care.